Welcome to Calculator. Today we're going to go through some live rates and then do a deep dive into a loan topic. We will get into that here shortly. We'll wait a couple of minutes to get started here to go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn. So thank you everybody for tuning in. We did put the comments on the screen, so feel free to drop a comment there as you tune in. We appreciate it. We will wait just a couple of minutes for everybody to be able to tune in and also to go live on all the different platforms. But thank you, everybody, for tuning in nice and early. I see some comments coming in there from Adam, Mark, Owen. Appreciate that. Feel free to drop a comment for those just tuning in. We're going to start it here shortly. All right, it looks like we are live on all the different platforms, so we will go ahead and get it started here for today. I see more people dropping comments. Keep dropping comments here as we go and drop any questions that you have. But welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do on this show every morning is go through live mortgage rates, and then we do a deep dive into a different topic every day. Now, we are a correspondent lender that specializes in non-QM loans. And one of the loans that we specialize in on the non-QM side is asset utilization. That is our deep dive topic for today. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to do a deep dive into that topic and let us know what asset utilization loans are, how we can use them, and then pull up some actual live rates for them. But before we do that, we're going to do what we do every day, which is pull up our pricing tool and go through live rates for different programs. So, Nick, let's go ahead and pull up that pricing tool and see what the market is looking like this morning.
All right, let me switch my screen and we will check it out. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you would like a full breakdown of a full loan estimate of all the fees that go into the APR that we're about to see here on the different programs, please get with one of our team members. We have over 350 loan officers in 24 states for primary and second homes, and we can do our business purpose investor loans in 44 states. And what we will do today is put a basic scenario into our pricing tool here and compare the APR across the programs. It is August 8th, just after 11 a.m. Eastern. So most of our standard programs are live with rates. So we'll set up the same scenario to compare. We'll set up a $400,000 loan amount. We'll set an LTV to 80% loan, 20% down payment. Set the desired price to 99. That means we're going to ask our computer to find the best rate at one discount point in cost, which is a typical request. And we're going to compare our programs here. First, we'll check out our conforming conventional. Then we'll go into the FHA options this morning. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. We also offer VA and USDA. Remember, VA is only for our eligible active service members and veterans. If you do happen to be eligible, let us know. We can quote it, no problem. And same thing with USDA. That's only for properties that are in a USDA eligible area. If you do happen to be shopping there, let us know. We can quote that, no problem. But first today, we'll start with conforming conventional. We'll set up the same scenario here. Purchase, 30-year fixed loan, standard, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40%. So with these basic settings, as we do every morning, let's check out the conventional options. And it's about the same as it was yesterday. No real change here. 7.125 rate, 0.875 discount points and costs. Final APR, 7.287. So we can use the APR again to compare the costs across the programs. The APR does include all the different fees that go into the actual loan. So this allows us to compare apples to apples across the program. So if for any reason our customer doesn't qualify for conventional or just wants to check out the FHA options, usually the next program we'll check out is FHA. So we'll set up the same exact scenario, choose FHA, and everything else will stay exactly the same. That way we can compare APR across the programs. So let's check out the FHA options this morning. And again, not much change there. Hopefully we see some downward momentum soon. 6.5 rate, best option, 0.75 discount points and costs. Final APR just a touch over 7 at 7.084. So in this example, as I say every morning recently, is if a customer qualifies for both conventional and FHA might actually be a touch cheaper, even though FHA does require a upfront mortgage insurance and yearly mortgage insurance to be paid. So the APR does include those costs. So please keep that in mind. And our customers that must use FHA, obviously, it's a great benefit to them as well, as FHA allows a little more leniency on other types of guidelines. Now, where we really love to specialize here at the Mortgage Calculator, and going to be one of the topics that Jose is going to go over a little bit later, is if our customer doesn't qualify for conventional or FHA for any reason. Many other banks or lenders don't have other options, but fortunately, we have over 5,000 additional loan programs under expanded guidelines, also known as non-QM. So if we set up the same exact scenario, everything else will stay exactly the same. We can now choose a different income option. So full doc is what we choose. If we're doing a conventional or FHA loan, that's 2 years of tax returns. That's what most people are used to. So typically we'll choose the non-QM options to take advantage of one of these alternatives, such as asset-related programs, which Jose is going to go into detail today. We have business bank statement programs. We have our investor programs we'll talk about for investment properties in a minute. Our most popular program by far is the personal bank statement 12-month program. That's what we always use for our demo. We also have RSU, stated, VOE, 1099, P&L, and no income CDFI. But for the demo, we always use the personal bank statement 12-month as our most popular option, and that's for our self-employed borrowers. Many times when our self-employed borrowers submit 2 years of tax returns, they have different write-offs or different things that may cause them to not qualify at all, or may cause them to not quite get as much income as they really want for that home. So therefore, we use this option to determine their income using just their last 12 bank statements. No tax returns involved at all. And we're going to, in this example, determine a debt-to-income ratio of 40% using just their cash in the bank and their regular expenses there. So no tax returns involved at all. Most of our self-employed borrowers will qualify for double, triple, or more of the income that they would conventional using these methods. So this solves multiple problems for our borrowers that just may need a little bit of extra help, especially our self-employed borrowers. So with these settings, let's check out our basic non-QM options this morning. So best option here, 7.25 rate, 2.375 discount points and cost, a little bit more cost here for the non-QM programs, but the final APR here, 7.362, almost identical to conventional. So we love when these non-QM options are very close to our conventional rates. There's a ton of other options though as well. If you scroll down here, you notice we have dozens, maybe even hundreds of different variations of this program. Some may allow credit events like foreclosures and bankruptcies, which would otherwise not qualify us for a conventional or FHA loan. So not only can we get around the income issue, some of these options at a little bit higher rates or APRs may also allow credit events and things like that. So please get with our team members. They will find the best option for you. Now, before we go into Jose's deep dive into the asset utilization version of non-QM, we always want to do live rates for investment properties. So let's set this to investment property. We love to work with investors, whether you're a first-time investor or seasoned investor, we have some great options. Let's set up the scenario same as before, 80% loan to value, 20% down payment. And we're simply going to compare our two options here for investment properties. We will have conventional options and we'll have our non-QM options. Remember, all the government programs are not eligible for investments. So FHA, VA, and USDA are not applicable here. So we'll start today with our conforming conventional options. Everything else will stay exactly the same. The only thing we've edited here is the occupancy. So now we can see the adjustments that the conventional programs have added for investments. So best option here, 7.5 rate, 3.375 discount points and costs, and a final APR of 7.746. Again, I think identical to what it was yesterday. So in this case, our investors that qualify, that's great, but many of our investors would like to see a slightly higher rate option in order to reduce these discount points. In this example, 3.375 discount points is $13,500. That's quite a bit of money that most investors would rather deploy into another investment. So many investors would ask for a higher rate. Unfortunately, here with the conventional options, there is no one discount point option or higher rate option to reduce this. That's where we love to present our final demo here. Set up the same scenario, and this time we will choose expanded guidelines, also known as non-QM, for our investment property. And first we must select our income just as before. And the most popular option by far, and our most popular loan here at the Mortgage Calculator, is the DSCR loan. And that is because it doesn't actually require any income or employment from our borrower. We're simply going to use the estimated rental income from the property to determine a DSCR, stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage payment, that's a ratio of 1.00 or higher, aka the property cash flows on a monthly basis. Even if the property does not cash flow on a monthly basis and the ratio is under 1.00, we still have many options for that as well. However, for our demo, I will always put 1.5, which is the highest value. Therefore, we can see all the different options pop up. And finally, a prepayment penalty. 3 years is standard for these programs. That's what we always select in the demo. There are options for 0 that will limit the loan programs and cost more. There are options for 5 that will limit the loan programs and cost less if our borrowers want to hold the property. We will always choose 3, so we show the most common options here. So with these selections, let's check out the DSCR. All right, I think that's a tad lower than it was yesterday, which is pretty cool. 8% rate, 0.85 discount points in cost, puts our final APR at 8.062. So remember the conventional options for an investment property, we're right at 7.75, so we're within a quarter point of conventional with a DSCR. So most of our investors, when they see a DSCR option side by side with a conventional option, and there's only a quarter point APR difference, say 90% plus of investors will choose a DSCR option, not only because it doesn't require any income or employment, but you can also start multiple loans at the same time. A lot of other benefits and flexibility as well. Also, as we scroll down here, some of these programs may allow things like foreclosures and bankruptcies, as we mentioned before, that non-QM does allow in some cases. And some of these at a little bit higher rates and costs may allow things like short-term rental income to be used, which was one of our topics last week. So definitely check out the different versions of this, and please get with our team members and they'll find the best option for you. Now, let me switch my screen and we'll get into our deep dive for today, which is going to be on asset utilization loans. So a very unique flavor of the non-QM products that we offer there. So notice every morning when I go through there is an asset related option in the pricing tool. But they do vary from outlet to outlet and program to program. So it'd be a little misleading to do that live on the show. It's not a very standard program. So Jose will have some very specific examples here of how we use these programs. And hopefully you can explain what kind of borrowers this would be for, Jose. I think a lot of people would really like to know who this program is really built for. So if you're ready, go ahead and take it away.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. Um, Asset utilization, a very interesting concept. It is meant basically for, I mean, I don't want to say just high net worth individuals, but for individuals that have a good amount of assets saved, liquid assets, basically. So, what we're not talking about properties that are paid off to pledge. We're not talking about artwork. We're not talking about fancy cars that are or anything like that that is paid off. Yes, those are assets, but they are now what we would consider liquid assets that can be easily liquidated, uh, and that can be plugged into their formulas basically for how asset utilization works. So the main thing is they have to be liquid assets, right? So we're talking about checking accounts, savings accounts, we're talking money market, IRAs, 401ks, retirements, stocks, bonds, mutual funds, all that kind of stuff we're talking about. Now, obviously, if we're using stocks, bonds, IRAs, there will be adjustments on the amount, on the percentage of the asset that they will use, right? As is the case, as you know, when you're doing your full doc files, Fannie Freddie, they will put percentages on those when you're using them for assets for reserves as well. So similar scenario here. Uh, you're not going to get 100% of those, but you will get 100% of your stock of your money market, checking, and savings. Right. So this is really good because you do not have to pledge these assets. Right. Most of the times, people think that you have to pledge the asset in order to be able to use asset utilization, but you do not. That's the beauty of it. They can, whatever they have now in the bank, that's what's going to work. And if they decide to do something with it later, there's nothing really that's going to happen in that respect. You will still be able to use those assets. So um, your borrowers that have those great big portfolios, or for example, a retiree is a perfect asset utilization candidate. They saved up all their life. They have their nest egg, a couple $1 million in a 401k, in an annuity, for example, that's getting them nice interest income, but they don't really have enough to qualify for the home that they're looking for. Well, asset utilization is a great one to be able to do that. So very good options there. So let me get into some quotes that I have here for you for some primary and for some investment property purchases. All right. So first example here, asset utilization, 90% loan to value of a primary one unit property. Now, keep in mind, 90% is the maximum LTV for this product, as for all non-QM products. But for this product in particular, there are very limited options at the 90% LTV figure. So you would definitely want to share with your borrower the 90% option and the 85% option that I'm going to share with you shortly to see which is going to have the best cost benefit analysis for them. In this case, you're looking at 10.5% being your lowest cost option, and you can buy that down to 9.25% as your lowest rate option. So that's at 90%. Now, at an 85%, you see that the uh, highest and rate, which has the lowest cost, in this case, it even has a little bit of a lender credit, $531, is 9.375, which is 1.125% lower than the 90% option. And you can buy it down all the way to 8.125 versus the other option 9.25. So the spread between the two remains 1.125%, which is in our loan here, it's about a $500 payment difference, right? So quite a substantial payment difference. You would really want to see what that payment difference is. Factor that out over how long they're going to be in the property, and there's a good possibility that you're going to eat up that 5% LTV difference between the difference in the cost and the difference in the payment for maybe 2 years. You'll probably eat up that 5% LTV difference. So again, 9.375 lowest cost option, and you can buy it down to 8.125. And then here at 80% gets even a little bit better. We have 8% with a lender credit, and you can buy that down to 7.5% at a cost of 2 points. So our investment options are pretty good as well. We can go all the way up to 85% for an asset utilization loan. Again, yes, the rate is a little bit higher, but this is an investment property at 85%. And recall that if you were doing this conventional, you'd be limited to an 80%. And you would have to hope that your borrower has a high credit score and that the property is not a multi-unit or anything like that, because there will be loan level price adjustments that may uh, take your loan out of compliance with points and fees, as is happening so often with those conventional loans at the 80% LTV limit on investment properties. So here you're looking at 11.124 as our lowest cost option. And you can actually buy it. Is this They have a pretty deep rate sheet here. You can buy it all the way down to 8.749. I believe that's around 3 points. And now for the more usual option, as you can see by the very big difference in the rates, now we go to 80%, right? 80% 1 unit asset utilization, and you see the rates drop dramatically, right? I'm going to go back over here a second so you can see it was 11.124, right? At a payment of $4,087 there. Now, this is 8.75 as our lowest cost option at a payment of $3,147. So that's almost $1,000 a month difference. So that 5%, if they have it, the extra 5% down definitely will yield much better results, because you can buy this all the way down to 7.49%. Very good option. And then, last but not least, I have here an asset utilization 80% LTV investment option, right? And again, a nice deep rate sheet here where your lowest cost option is 10.124%, and your lowest rate option is unbelievable at 8.374%. So this option does give us many rate choices with not much of a difference in cost on those rate choices. So you can go all the way down to 8.374. And the max LTV on a cash out for primary is 80% as well. So 80% is the max for any cash out refi options. For asset utilization, 90% is the max for a primary purchase again, but 85% is going to yield much better options for you.
All right. I don't see any questions here, but definitely a great program. I mean, if you have those clients out there that have a high net worth, have money in the bank or 401ks or whatever it is, then they can get a loan, right? Easy peasy. Looks like there is a question here. Am I needed for over 80% for this specialty product? Remember, non-QMs do not have mortgage insurance. Non-QM loans do not have mortgage insurance.
Correct. Never any mortgage insurance for any non-QM. And it's really cool what Kyle was mentioning about, all how your borrowers with those types of investment accounts could get these loans, because previously, um, before non-QM came out with this product, the only people that could get something like this would be, you had your account at Merrill Lynch, you had $2 million in stocks, they would let you put your stocks as collateral to lend you money on your assets. But this is taking it one step further. Remember, they're not pledging anything here. They're just plugging in a formula, which our next question, if you want to pop that up there, Nick, it segues right into the next question. How do we determine how much assets are needed to show for this loan? On that one, definitely if you attend tonight's training on asset utilization, which is tonight's training, I'm going to get into different computations for it, because it is specific to the investor that's being used for the loan, right? They all have their own formulas. They all have their own guidelines. So it's going to be a certain percentage of the assets divided by a certain number of months, and that's it. It's pretty easy, very easy computation. The only main thing to take into consideration is that they have to be liquid assets that fall into the various categories that they have, and depending on the category of the asset, is going to be the percentage of the asset that you can use towards the calculation, with the best case scenario obviously being 100% of the asset value.
All right, great questions. So if you want to, get more info on these loan types, you can always visit us at themortgagecalculator.com. We can pair you up with one of our 350 loan officers from all across the country. Remember, we do this show at 11 a.m. Eastern time every single weekday, where you can tune in and see the live rates for the day and then see the deep dive into a different loan topic. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we hope to see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody.